Welcome to The Explainer. Today, we're putting on our professional equity analyst hats and embarking on an enthusiastic detective-like quest. Our target? Sabra Healthcare REIT. We're going to dig way past the flashy headlines, tear down the financials, and conduct a totally rigorous stock valuation to uncover its true intrinsic value.
To kick things off, let's anchor ourselves. Right now, Sabra trades at $20.46 a share. This is essentially the stock's public persona. It's the price the market has slapped on it today. But hey, as any seasoned analyst will tell you, price is just what you pay, right? Value is what you actually get. So, what is the underlying value here?
Okay, let's dive into this, because according to the raw data dump we're analyzing today, the suggested fair value price is sitting at a whopping $36.93. That implies a massive 44.60% margin of safety. If that's true, this stock is literally a screaming buy. But, our job isn't to just blindly accept that number. Our job is to rigorously stress test it.
Here is our roadmap for the explainer. We'll start with the target, move on to absolute valuation, conduct some relative peer comparisons, calculate the asset-based valuation, and finally deliver our final verdict. All right, Section 1. Sabra REIT, the target. Sabra is a real estate investment trust with a pretty solid footprint. We're looking at a $5.16 billion market cap. Trailing 12-month revenues are hitting just over $774 million, dropping about $155.6 million to the bottom line as net income. And year-to-date, the stock has delivered a very respectable 9.65% return. So, it's a healthy, functioning business. But the big question remains, is it actually undervalued? Moving right along to Section 2, Absolute Valuation, Cash Flows. Now, normally an analyst's absolute best friend is the discounted cash flow, or DCF model. But, well, here's the catch. Sabra's trailing 12-month free cash flow is currently sitting at negative $104.32 million. A traditional DCF model just totally breaks down and becomes incredibly fragile when current cash flows are negative like that. So we've got to pivot. As a REIT, Sabra's value is heavily tied to its payouts. That means we shift our focus to the dividend discount model, which is thankfully empowered by a very strong, very real 5.87% dividend yield.
So the absolutely crucial point here is getting our assumptions right for the dividend discount model. We know the current yield is 5.87%, and the forward yield on cost over 3 years is projected at 6.22%. Now, the source documents don't just hand us the terminal growth rate or the cost of equity, so we really have to apply some sensible defaults. For a mature real estate portfolio, baking in a 2% terminal growth rate is standard practice, basically keeping pace with long-term inflation. For the cost of equity, or our discount rate, 8% is a totally fair expectation given this risk profile. If we project out that expected forward dividend and apply the Gordon growth formula, dividing the dividend by our 8% cost of equity minus our 2% growth rate, the model actually lands us right around $20 a share.
Just to be perfectly thorough, we can also run a residual income model as a secondary absolute check. This model essentially takes the current book value and adds the present value of future excess returns. But honestly, here is where we hit a bit of a red flag. Sabra's return on equity is only 5.51%. If our cost of equity is 8%, Sabra just isn't generating excess returns over its cost of capital right now. This definitely points to some headwinds and confirms that any valuation wildly above its current price is going to need a very strong justification.
All right, Section 3, Relative Valuation, Peer Comparisons. Let's see how it measures up.
Now, what's really interesting about this is the historical context. At first glance, Sabra's current price-to-earnings ratio of 31.97 might sound kind of high. But check out its 3-year average of 36.75. Sabra is actually trading at a 13% discount to its own historical baseline. If the market decided to re-rate this stock back to its 3-year average PE, you'd be looking at an implied intrinsic value of roughly $23.50. So on this metric alone, it definitely looks slightly undervalued.
But hey, a good analyst never relies on just one multiple, right? When we zoom out and look at the broader picture, the story gets a bit more complicated. Sure, the PE ratio looks cheap, but take a look at enterprise value to EBITDA. It's sitting at 16.89, which is nearly 10% higher than its 3-year average. The price-to-book ratio is 1.82, running over 18% hotter than its historical average. So while earnings multiples are hinting at a discount, the balance sheet and operational multiples are basically telling us that Sabra is actually trading at a premium compared to its recent past.
Time to put on our liquidator hats. Section 4. Asset-based valuation. Net assets.
We can actually reverse engineer this to figure out what the physical properties themselves are worth. First, the enterprise value to assets ratio is 1.39, which shows the market currently values the firm notably higher than its raw asset base. Then, we factor in the liabilities, utilizing the 0.90 debt-to-equity ratio. Applying these metrics alongside the current stock price gives us a bedrock net asset value of approximately $11.24 per share.
Now, before anyone panics about a net asset value of $11, we absolutely have to look at liquidity. Sabra's current ratio and quick ratio both sit very comfortably at exactly 1.48. In plain English, that means Sabra has $1.48 in liquid assets for every single dollar of short-term liabilities, so their short-term liquidity is completely stable, which gives us a ton of confidence that the balance sheet isn't going to crumble before assets can be properly valued. They aren't in financial distress. They are simply trading at a premium to their liquidation value, which is incredibly common for a functioning REIT.
All right, let's bring it all together. Section 5. Synthesis, the final verdict.
And this brilliantly illustrates the massive discrepancies you uncover when you do the math yourself. Just consider this spread. Our dividend discount model, based on totally reasonable assumptions of a 2% growth and an 8% discount rate, pegs the value at roughly $20, meaning the current market price is totally fair. Our relative PE model suggests a slight undervaluation at $23.50. The raw net asset value sits way down at $11.24, and then, floating way up there, is the source data's fair value estimate of $36.93.
So when we synthesize all this data, a much clearer picture emerges. That $36 target relies heavily on incredibly aggressive growth or margin of safety assumptions that our standard absolute and asset-based models just cannot replicate. I mean, especially with negative free cash flow and a return on equity that's actively trailing the cost of capital. Look, the dividend is strong and it is well supported by liquidity, but from a rigorous intrinsic valuation standpoint, Sabra appears fairly valued right exactly where it is today, hanging out in the low 20s.
Which leaves us with this final thought. High-yield real estate investments often have this alluring fair value printed right next to them. But as we've seen today by really tearing down the numbers, a high yield and a theoretical target price don't automatically equal a bargain. You always have to ask yourself, in the world of real estate, when the market price is an asset near its fundamental dividend value rather than its aggressive growth target, is it offering you a bargain or is it giving you a warning sign? Thanks for joining me on this deep dive into Sabra Healthcare REIT. Keep questioning the numbers and I'll see you in the next explainer.